Well, thanks everybody for inviting me to present our story, Lavras Gold. We're focused on gold exploration in Brazil. And what I wanted to do with this presentation was a couple of things. I wanted to, not just talk about our company, Lavras Gold, but I wanted to address a real generational issue that's started to occur, at least in my career over the last 14 or 15 years or so, which is that there's a lot of young people, probably a lot of people in this audience that really don't know anything about the mining industry. And it's because this industry's been in a bear market for such a long time that the interest level has just waned. And I was actually at a conference in Zurich, Switzerland 2 weeks ago, and on the panel, this is exactly the point that one of the panelists made, which is that there's a lot of people that really don't know anything about mining. So what I wanted to do with this presentation is not just talk about Lavras Gold per se and the success we've had in terms of discovering a new gold deposit in southern Brazil, but I also wanted to spend a little bit of time just talking about the structure of the mining industry. And it's very relevant because I know a lot of people in this room are interested in rare earth elements. They're interested in battery metals, lithium, and that sort of thing. And so this general sort of introduction really does address a lot of that. So what we're going to talk about is really just a little bit of understanding about what the whole mineral supply process is all about. Talk about exploration, mine development, talk about production. Then I want to kind of get into the gold market a little bit because we're in the business of looking for gold. We've sort of got out the middleman, and our business is actually gold mining, and that's what we do. I want to talk a little bit about the state of the gold market, and I think we're actually very close to a major breakout. As many of you in the room who are invested in gold know, the gold price is very close to its all-time high. I think we closed around $22,040 an ounce, something like that today. So it's a very, very interesting time. There's a lot of geopolitical tension in the world. There's a lot of economic stress around the world, and this is why you want to have exposure to gold, which is actually real money. And then at the end of the presentation, what I'll do is just leave you with an actionable call or investment call, which is hopefully to invest in our company called Lavras Gold. So when you think about the gold industry, you really have to think about it, or not the gold industry, but the mining industry. You need to think about it in terms of the mineral supply process. So essentially what's happening is it's the demand for commodities in the marketplace that guides the selection and the occurrence of mineral deposits in the world, in the earth, guides the selection of environments for mineral exploration. So what is mineral exploration? Basically, it's a bunch of people like me, geologists. We go out, we actually have to find these metals that people want. And so we go through a series of steps looking in favorable geological environments. We spend a lot of money, and it's high risk, high return type of business, but we spend a lot of money looking for these deposits. When we find something, a mineral occurrence we call it, let me just figure this out. When we find a mineral occurrence, we have to determine whether or not it's economic to actually mine this thing. So what does that mean? Well, it means we need to understand the grade, we need to understand the tons, we need to understand, is this deposit near surface, is it underground, what's the mining method, what's it going to cost to get it out, all that kind of stuff. You build cash flow models. And you have to consider, the commodity markets, the sort of the short-term fluctuations, the long-term trends in metal prices. So it's a very, very difficult business. But if you find something that is economic, then you go into that whole mine development stage where it takes a few years to get your permits. You have to do all the engineering work and then ultimately build the mine. And finally, you get into productive capacity where you're generating free cash flow, hopefully. And at the end of that process, you gotta, reclaim that mine and turn everything back to the way it was before you found it. And there's a lot of unique features about this whole supply process and this whole business of mining. And the main thing that's different about our industry versus pretty much everything else is that when you find a mineral deposit, it occurs where it occurs. You can't pick it up and you can't move it to your local market. So that means you have to be concerned about the country that you're in or the region that you're in, the communities that you're impacting. The other thing is that you're dealing with a lot of what we call geological variability. In other words, there's no such thing as a typical mineral deposit. Some of them are high grade, some of them are low grade, some of them are near surface, some of them are deep. So there's a lot of factors that you have to consider that you just don't have any control over. As I mentioned earlier, you're dealing with commodity markets. When is the gold price going to break out in the case of gold mining? Are we at the cusp of something very significant? I personally think we are. That's important. Or is it going to be a bear market? Are these prices going to collapse on us and nobody cares again? And you need to consider all the economic trends in terms of exchange rates, capital markets, access to capital, that sort of thing. Very, very difficult business. And offsetting all of this is every time you mine a ton of ore from any kind of a mine, that's called depletion, you got to find it and replace it. And so that causes the cost of mineral supply to actually rise over time in terms of long-term trends. But offsetting that is advances in technology. So there's this dynamic at play that sort of dictates where prices go over the medium to long run. So this is just a very simple chart that sort of just culminates what I've been talking about. Basically, in the expiration phase, this phase number 1, if you like, you're spending a ton of money. And it's high risk, high return, and you're looking for that discovery, that economic discovery. Most of the time, you're gonna not find something that's economic. It's a very difficult business. 1 in 400 mineral occurrences actually becomes economic. 1 in 400. It means you've got to drill a lot of mineral occurrences to actually find something that's potentially economic. And then, if you look at the distribution of returns from this industry, it's the classic 80-20 rule, which is that 80% of the value of your mineral occurrences is in 20% of the highest quality deposits. So there's a very skewed distribution in the value and the returns from this industry. And that's something that's very important to understand, because everybody, when they get into this junior exploration game, they think you're going to get the big win. But the reality of it all is it's very difficult to find that deposit. Anyway, the second phase is what we call mine development. That's the time period it takes to build that mine. Then finally you're up and running and you have cash flow coming out. So how does this manifest itself in the stock market? So my background, just to give you a bit of background, is I actually worked as an exploration geologist in Canada, worked all across the country. And then I ended up on Bay Street. I worked as a mining analyst for many, many years with a lot of big investment banks, traveled around the world. So I have a very good understanding as to how this whole cycle works, and certainly visited a lot of mines over the years. But basically, in the exploration phase, this high risk, high return phase, you're out there looking, you find something, and then you can get a real pop in the share price, because that's the real value creation in this industry, is when you actually find something that's real. And so there's a lot of speculation in this phase. You can get 5 or 10 baggers, which is really what you're looking for, or more. If you're going to go into the high, it's everything, it's like high risk, you want big return. Low risk, you want low return. And so if you're getting into the exploration game, just be aware of what those risks are, but you want that return potentially. But what happens is you find something, a lot of speculation, share price goes up, then reality starts to set in. People start to do the economics. How long is it going to take to build this thing? What's it going to cost? All that kind of stuff, discounted cash flows. Reality sets in, you got to build the mine, the share price behavior sort of goes down, and then ultimately you get into production, and as the cash flows start to accrue to the company, you'll see a pickup in the share price. So that's typically how this industry works and how the shares react to what stage you're in the market. Talk a little bit about the gold price and the gold market, because that's the business we're in. Basically, this chart, sorry, I'm just playing around a little bit with this laser pointer. This first chart really just shows some of the longer term cycles in the gold price. In the 1970s, we're in an era of very high inflation. During that time, the gold price came off the gold standard. Many of you may or may not be aware, but the US dollar was actually backed by gold. It was set in Bretton Woods after the Second World War. So the price was fixed at $35 an ounce. Nixon took it off the gold standard in 1971, and that's when you saw the price of gold rip. This is the time when fiat currencies became all the rage. In other words, this is the time that governments could start to print money and basically devalue your currency. So if you think about what money really is, it's a store of value, it's a medium of exchange. Store of value, think about that. So if you've got a government, if your pie is this big, and you keep just printing money, you're not actually creating value. All you're doing is creating more pieces of the pie. And so you got more pieces of the pie, but you haven't actually created any value. So that's devaluing that individual sort of unit that you have in your bank account. And that's basically what's been going on. And then we went through a sort of a period of sort of flat gold prices in the 80s. And then we got a really nice rip, cycle number 2 in the early 1990s, the late 1990s. That was really, I remember that. That's pretty much when my career started. I was a gold mining analyst, global gold mining analyst at Morgan Stanley. And I can tell you in 1999, 2000, 2001, I was like the Maytag repairman. Nobody would call me because nobody cared about gold. You had a very strong dollar, and this is the time that the internet was actually being built out. And there was an analyst named Mary Meeker, who we call her the internet queen, and she was just printing money. They were just underwriting anything that had .com, and they would just underwrite that, and away you go. But that all came crashing down, sort of 2002, 2003. And all of a sudden, you know, you had what we call the tech wreck, and nobody cared about technology anymore. And that's when our sector took off. Everybody wanted to own a hedge against declining stock markets and declining US dollar. And that's when the gold price did its sort of second cycle. And superimposed on top of that was the commodity super cycle, which is when China started to really come to the fore and just really demand a lot of commodities because they were building out their economy. And then that all kind of came crashing down and into where we are right now, where we've seen another sort of a big cycle in technology. You know, AI is all the rage now, but before that it was, you know, all these other things that I don't really pay a lot of attention to, quite frankly. But anyway, these cycles, you know, they can last a long time, but when they turn quickly. And so really the thesis for gold is that it's, as I used to say to a lot of portfolio managers when I was marketing, is it's really a negatively correlated asset class. So if you feel like we're topping out in the S&P, you've got a very narrow, you know, 7 stocks that are really driving that performance and everything else is flat to down, then you need to hedge your portfolio. So the way to do that is gold. And there's a disconnect going on in this global economy that, or I guess it's not so much global anymore, it's ripping apart. But in the West, people are not buying gold or physical gold. In China, they're buying physical gold. Why? Because their housing markets are collapsing. And they're paying something like $120 an ounce premium to the spot gold price to buy physical gold right now. And it hasn't happened over here yet. So the other thing that's going on is the central banks are buying a lot of gold. And that's really quite interesting. What do they know that we don't know in terms of diversifying their reserve assets? So something to think about. In terms of the behavior of gold stocks or gold equities, it's very interesting. Let me go to the next slide, actually. It's very interesting. Typically, it's kind of like a slinky. Basically, the gold price moves first, and then you'll see the gold equities move afterwards. And so this is shown in this chart on the the right-hand side of the slide. So it's not, in my opinion at least, not the behavior that we're seeing in the gold equities right now, which is that they're lagging. It's not surprising. But we are seeing that gold price break out, and it's just a matter of time, in my view, that we'll see the equities follow. In terms of the gold equities themselves, as I mentioned, there's 3 types of equities. You can buy exploration, high risk, high return. You can buy mine development stocks, or you can buy operating companies like Barrick Gold or Agnico Eagle or companies of that kind. And this gets into the whole concept of alpha versus beta. So typically, in my experience looking at the behavior of gold equities, you get about a 3% move for every 1% move in the gold price, generally speaking. For these bigger companies like Barrick. So that's called beta. But if you want to get alpha, as I mentioned, this is where you're going to get alpha. You're going to get alpha in the exploration stories that find something that's real, because they're actually really creating wealth. When you find a deposit which wasn't there, you know, before you started drilling it out, and then you find something you've created, say $1 billion of value, because that's what this deposit or this mine is worth, that's called alpha. So that's the difference. And because you're going for high risk, high return, you're actually looking for higher performance, sort of 5 to 10 baggers, as we say, or more. Should I start dancing here? I don't know. All right.
We're not silent.
You step on it.
Yeah, just throw it out the window. Go ahead, Mike.
Okay, that's cool.
Just so we continue, like, do you guys remember that Lassonde curve? Go back to that slide 2 seconds.
The Lassonde curve?
Yeah, just.
Sure.
Okay, just take a picture of that. Now go to the next 2 slides with your chart. I'll let you comment on what's happening.
Yeah, so a little bit on Lavras. So now we're going to get into the investable idea that I'm hoping to leave you with. So Lavras Gold, basically we're a relatively new company. We actually went public in April of 2022. So I don't know, 19 months ago, 20 months ago, something like that. Have a project in southern Brazil, and we got spun out of a predecessor company with $10 million in cash. And basically we got 2 drills on our property, and I'll talk about that in more detail in a moment, and started drilling off a number of targets on our property. And we've actually made about 6 or 7 new discoveries since we went public, but we made a major, what I think is a major discovery at least, called Fazenda de Posto. And we disclosed those results in August 29th actually of this year. And I call it the $50 million drill hole because our market cap went from about $10 million to about $65 million in about 2 weeks. And so it was quite something, and it really did position us well to be able to raise money. We completed a financing, $13.7 million in September. And so we now have a lot of cash on hand. I brought in some very strategic shareholders, including Lavras Gold, which is a well-known gold mining company. We gave them 5% of the company. And really that was to validate the discovery that we've made. And certainly we're very excited by what we've done in Brazil. And we're drilling away, and we hope to prove that we've got one of these rare, potentially world-class type of situations. A lot of work to be done to prove that, but that's what we're trying to do. In terms of Brazil, it is a kind of an emerging market in many respects, but it is the largest country in Latin America. And I can tell you, I've probably visited pretty much every country in Latin America and Central America. And Brazil is the largest country in terms of population. It's a very sophisticated economy. Vale, which many of you may have heard of, is the largest iron ore producing company in the country. So they have a very sophisticated set of rules to go from exploration to mine development and operations. And they have a very sophisticated group of people, good mining engineers, good geologists, and so on. There are some big companies there as well. Kinross is one of the major companies on the gold side. Hochschild's is there. AngloGold Ashanti, which is a South African gold mining company, is there. And G Mining Ventures, actually a group right out of Montreal, is building a 2 million ounce gold deposit as we speak. That should be in production probably in the first half of 2024. So where are we? Just a little bit on Lavras Gold. We're in Brazil. We have a mix of technical and capital markets professionals, which is very important. I like to say that when you're going to buy a company like Lavras Gold, the financial engineering, as I call it, is just as important as the technical engineering. When I talk about financial engineering, I'll get into this in a moment, is that you need to have a very tight capital structure. The problem with this industry is you have a lot of companies that destroy their capital structure by issuing too many warrants. And so it caps the share price performance. And so what you want to do is have a very tight capital structure. And we are certainly trying to maintain that. In terms of where we are, we're primarily focused in southern Brazil. We already have 1 million ounces of gold resources outlined. And with this new discovery, we expect we'll grow it from there. This is what it looks like. Basically, it's an area of very good infrastructure in the south. Sao Paulo is here, 2-hour flight to Porto Alegre, 4.5-hour drive by paved roads like this. It's basically agricultural land and cattle ranching. And we've got power, we've got infrastructure, and all the sort of things you want, water, the sort of things you want to build a mine. As I mentioned before, the mines are where they are. And so we decided very strategically to go into areas of good infrastructure because it's a lot less costly when you're exploring and developing. couple of quick comments on geology, and I'll try and keep this very brief for the non-geology people in the room. What I did with this series of slides was just show you the physical size of some of the major gold systems in the world. To give you a sense as to size, the average gold deposit size is about 3 million ounces. And as I mentioned, there's this 80-20 rule. So if you take out the really large deposits, these ones that are 30, 40 million ounces or more, then the average deposit size is about 1.5 million ounces. So that just gives you a sense as to size of what we're looking at here. When we look at some of the world-class gold deposits, things like Porgera Mine in Papua New Guinea, which is 35 million ounces, things like Olympic Dam in Australia, which is over 100 million ounces. It's also a uranium and copper mine. When you look at something like Cripple Creek in Colorado, which is about 30 million ounces, these are world-class deposits. The average size is 3 million ounces. These are over 30 or even 100. These are 10 times bigger or more than the average deposit size. But if you look at the size of the distribution of the gold showings, or the structures that are hosting the gold, they range from anywhere from 3 to 4 kilometers to maybe 5 to 6 kilometers. At our Lavras project down in southern Brazil, we actually have gold anomalism and copper anomalism over an area of about 11 to 12 kilometers. So what this tells me as a geologist is that we actually have a very large mineral system. That's point number one. What you got to do is focus in to figure out where the economic concentrations of those minerals are to make it all work. And this is a busy slide, but really what I wanted to do with this is just give you a concept, which is, what are we dealing with at Lavras? This is a volcano, okay? It's a section of a volcano, and everyone knows what a volcano is, and this is just a magma chamber. So you've got these fluids coming up from this magma chamber, basically going up through these fractures in the rocks, and then basically depositing the gold. That's really what you need to know. And so if you go into a little bit of specifics on our property, just to give you a sense of scale. Imagine you're sitting in a helicopter looking straight down. This circular feature, that's what's left of the volcano sitting at surface. That's the remnants of that magma chamber I'm talking about. All of these little showings here, all these little labels are all showings on our property. That's about 12 kilometers by 11 kilometers in diameter. So it's a very, very large package. And we've been just basically exploring away. We've made, as I mentioned earlier, about 6 or 7 new discoveries. What got the market excited was this thing called Fazenda de Posto. And it's literally sitting beside 500,000 ounces of gold that we have at what we call Butia. So if this geological setting was sitting in Canada or the United States, I can tell you this would be mined out right now. No question about it. Yeah, and then here, this is another slide just showing,
This was the discovery, right?
Yeah, this is the discovery.
So the stock actually went to $1.50.
Yeah.
After being down for like 25 cents. So it just tells you the potential returns that you could potentially get in this space. Go ahead.
Yeah, so this red outline just shows our claims. We've got 29 claims, about 22,000 hectares of ground. Key word is contiguous claims, so we got it all locked up over that favorable geology, over that magma chamber, if you like. And we literally, with the 10 million that we started with, we started just drilling away. We started the company with 500,000 ounces. So very quickly after that, we added another 500,000 ounces. That gives you the 1 million ounces of gold. And then we just started drilling a number of these deposits. Call them singles and doubles, really. And then Fazenda de Posto is what got the market excited. Again, sitting right beside this 500,000 ounce gold deposit. And this is what it looked like. It was actually what we call a blind gold discovery. In other words, there was nothing at surface that was really telling us there was gold there. And it's amazing to me that we found this because there was some, historical mining there from the 1900s by the Brits, and they were literally a couple of hundred meters away from this, and they missed it. But what we did was we drilled this hole. We call it 23FP002. We hit about 117 meters of cover rock, and then which looks like this sort of salmon pink stuff. And then we got into this really long zone of mineralization. It was actually about 340 meters of 1.1 grams per ton gold, which is about $70 a ton rock, basically. And so it's quite unique to find this style of mineralization so continuous over that kind of length. So 340 meters, that's basically 3.5 football fields, just to give people a perspective. And so that's what got the market excited, and this is basically our $50 million drill hole, as I call it. Since then, we put out some more drilling results. We actually have 2 drills turning right now. And we put out this hole, we did a scissor hole number 6 where we got 204 meters of a gram, pretty much right from surface, about 30 meters below surface. So this is very exciting. It's starting to develop into something real. We're drilling away, and you know, hopefully we'll be able to tell you what's there in a you know, sometime next year. And that's it, really. I
I would go to the cap table. Show them the cap
You want to go to the cap table?
That's really important.
Yeah, okay.
Go to the cap table and maybe just comment on what's happening.
Sure. So basically, in terms of our cap structure, we have 51.2 million shares outstanding, or 51.3 million shares outstanding, just under $1 a share, so $50 million market capitalization. We had 14.3 million in cash at the end of September. And you can see our share registry. 20% of the company is actually management and insiders, so we're strategically all aligned with everybody, all investors. Eric Sprott is a well-known gold investor, is 15% of the company. And as I mentioned, we brought Kinross in, well-known major gold mining company, for 5%. And then we've got a mix of institutional and retail investors. Also brought in Rob McEwen and Larry Lepard's well-known gold investor. He's on our board.
So for the people that are new to like mining, anytime a guy like Eric Sprott or Rob McEwen get into a deal, you pay attention. Because stuff like this happens and there's usually a significant backing. And that geological representation, like Brazil right now, I'll leave this for the Q&A, but Brazil right now, there's a lot of opportunities for miners. Discoveries are happening. It's a jurisdiction that doesn't get talked about. And I think everyone here, just put it on your radar if this is something that interests you.
Okay, I think that's probably it. Yeah. Yeah, that's it. And this is just our team down in Brazil. And this is fun. This guy here is actually the mayor of the town of Lavras. And, you know, it's a motley crew. You know, we got I call them the Duck Dynasty guys, but we get the Brazil version, right? This guy and this guy. But anyway, you know, it's a great group of guys, and they're all from the community. And, you know, as I said, one of the things you got to do is get that social license to build a mine. So it's very important for us to have these people engaged in the community, from the community, because it's, in the end, it's really about their future. So I'll open up the questions from here.
Questions, guys. All the way to the back. Oh. Yeah.
Out of the 24 targets that you have known,
Yeah.
How many are those in that northeast region where you just had that most recent discovery?
Yeah, that's a good question. How many? There's probably, we've drilled off 1, 2, 3. There's at least 3 up to the north, about 1 kilometer. We've got, I can go back to the slide actually, because that's a good question. Yeah, you know what, I'm going to go here. Yeah, so we with the $10 million, I can go through it if you want, but basically with the $10 million, first discovery announced was something called Zeca Souza. That's actually about 1.3 kilometers north of this major discovery that we've made at Fazenda de Posto. Slightly different style of geology, but we're getting very, very high grade, visible gold, you know, very shallow. So things like, you know, 4 meters of 46 grams per ton gold, sitting about 30 meters below surface. And so that's very significant because, you know, 46 grams per ton gold, that's, you know, that's bonanza grades. That's, you know, that's $3,000 rock basically, 30 meters below your surface. It might cost you $20 to get it out of the ground and process it. So, you know, that's one of them. We have another one called Canalera, which is located right here. That was actually drilled in 2007, 2008 by one of our predecessor companies. It's a kilometer-long gold-bearing structure that we know, and we hope to get to that hopefully next year if we have time. But there's a lot going on between Brutia, Fazenda de Posto, and along what we call the western margin of this intrusive complex. There's a big gold system bubbling up, basically, and we need to do a lot more geological work and in the end drill it and see what happens. But conceptually, I think what's going to happen with this project is ultimately you're going to have some kind of a centralized mill. In fact, we've scoped it out. It'll probably be over here somewhere. And you're going to be feeding this mill with multiple sources of ore from these various deposits. And some of these world-class deposits, things like Cadia Hill in Australia, for example, that Newmont Mining just bought, They have, I think, 5 or 6 deposits. It's 30 million ounces, and they feed it into this centralized processing facility. So that's hopefully what will end up going on here. Yeah.
At the beginning of the presentation, you mentioned something about high grade and low grade.
Yeah.
So which one is it for your discovery?
So I would say that's a great question. I would say for our discovery at Fazenda, the Posto, that would be called low grade. 1 gram per ton, 1.1 grams per ton is what we would call low grade. But it's near surface, and it's what we call bulk tonnage. So when you start talking about high grade and low grade, you got to understand the cost structure, right? How much is it going to actually cost you in an open pit mine when you're bulk mining this stuff, and it's very low cost because it's big volumes, right? So you're getting economies of scale. Sometimes with these higher grade deposits, yeah, you can have high grade, but if it's very narrow, and you have to mine very narrow gold bearing structures, you bring in what we call a lot of dilution. And so it can bring that high grade down, and these costs typically can be very high if it's an underground mine, for example.
And you mentioned as well the financial engineering aspect of this mining company.
Yeah.
They don't issue a lot of warrants.
That's right.
And why is that?
It's because, I don't know about your experience, but my experience investing in junior mining stocks in particular is that 9 times out of 10, these warrants never get exercised. So they get exercised out of the money. But the way a warrant works is that, companies will issue units, right? So it's like you get a common share and then you get a warrant at some sort of premium price that it will get exercised. So if, let's say you did a unit financing at $1 and you have a warrant at $1.25, so you would theoretically have to wait for that share price to go over $1.25 before that warrant has got real value. So that's one thing. It caps your share price performance, right? And like I said, for these types of companies, you don't want that. You want pure, leverage to your discovery. And so that's one thing. The other thing, the games that some of these funds will play, especially the hedge funds, I call it the fast money, is that what they'll do is they'll participate in your financing. They'll take your unit. They'll take your unit with your warrant. But what they'll do, and typically in a private placement, your stock is stuck for 4 months. You can't trade it for 4 months and a day. That's just the rules. But after the 4 months, what happens is they'll sell your common shares, right? And they'll keep the warrant. So they essentially have a free option on your company. But there's selling pressure because they're selling your underlying stock. So that's the reason that you want to be cautious with that stuff. Yeah.
On Lavras Gold Corp, on the chart, is it the TSXV that we have to look?
Yeah, that's the TSXV, and then we just also were listed on the over-the-counter market in the U.S. LGCFF, I think, is the ticker.
Yeah, I see
Yeah.
it right there.
Yeah.
Bottom left corner, case for one problem.
Yeah.
It's a more personal question, but what compelled you to retire your fancy suit and tie and go hunt for gold?
That's a great question. Well, geez, that gets kind of back to my roots. My first degree is in geology, and I was sort of out there working in the field and doing all that kind of stuff. And I can remember specifically being in some swamps in northwestern Ontario thinking, there's got to be a better way. And so I went back and did my master's in mineral economics and mining finance, basically. And then I came to Montreal, actually, and did my environmental engineering graduate diploma. Because I felt at that time, it's almost 30 years ago now, which is crazy, but I felt at that time that the environmental aspects of mineral supply is very up and coming, and it's very important to understand that stuff. But what caused me to kind of go back to the field, I'm kind of running the company, so the capital markets experience that I have is very, very helpful, just understanding what investors need. But I love the geology, just love it, and just getting into the science of it all, and just understanding like what's going on with the mineral chemistry and why is this thing sitting here. I mean, a mineral deposit is a freak of nature, and that's why it's so hard to find these things. But that's what I love to do.
We got time for one more.
Sure. Yeah. Whoever. Yeah.
This discovery was done many years ago. What was the years of the first discovery in this area?
Well, yeah, the Portuguese actually arrived in this area in the late 1700s. And the town of Lavras was actually established because of these Portuguese artisanal gold miners. So all of these old showings that we have on the property that I've labeled here are really old Portuguese workings. And so you can see those old trenches, the old workings on the property. But that's when they went in there.
I you're right on the contacts, or you're deciding on?
Well, yeah, I didn't really show it here, but let me see. No, I'm going the wrong way here. Let me, very quickly, because I know it's complicated, but this, you can see that there's it looks like a target, basically. You've got this intrusive, there's what we call, I didn't want to get into the geology, but this is what we call a polyphase intrusive complex. So these rocks are about 590 million years old, actually. We call them Neoproterozoic. And basically, you've got multiple intrusions that have come through a structure over a long period of time. And yeah, I'll just leave it at that without getting too complicated. But yeah. Yeah, one more questions? Yeah, sure.
Yeah, we'll do two more.
Yeah. Yeah.
What would you say is the average cost of drilling?
Yeah.
Cost per meter or?
Yeah, that's a great question too. So there's a couple of things I'll leave you with. It's costing us about $250 Canadian per meter to drill there. And yeah, 250, and that includes assaying, which is pretty low cost. If you go up into Alaska, for example, or up into the north part of Canada, it's probably $800 to $1,000 a meter to drill. And our average discovery cost per ounce of gold is about $11 US an ounce. The average for the industry ranges from $30 to $60 an ounce. So we're finding gold very efficiently here, and we hope to continue with that trend.
And how deep do you have to drill?
Yeah, that's a good question too. Our drills can go down 600 meters along the drill course, about 500 meters vertical typically. And really what we're hoping to do, at least in the first pass, is just go for the shallow stuff, so anything up to 300 meters depth. But these gold systems in particular can go down very deep. They can go down a kilometer and a half. That's well known. And we've drilled as deep as 500 meters and found gold mineralization. So we've got the lateral sort of opportunity in terms of these deposits, but also the vertical as well. So there's a long way to go here.
And you said how many drills left?
We have 2 drills on site. Yeah.
2?
Yeah, 2.
Progress?
Yeah.
You know, on a total of how much?
I'm sorry?
How many holes are you expecting?
Oh, so our budget is, we started our original budget when we started the company with 16,000 meters, and then we expanded it to 20,000 meters. And then we're probably going to do another, 12,000 to 15,000 meters in 2024, at least at this stage.
So just to give context, the more meters you expand on, the more your resource base develops. So then you build on more of your asset, and then you become more valuable as a. So the more you discover things, the more you might want to expand your meters to develop more of your resource.
Yeah. Yeah.
For your drill program that you're going to continue, are you going to be infilling between those 2 discoveries, or are you going to be stepping out more to the northeast?
Yeah, a bit of both. It's a good question. We're going to focus, at least in the near term, on Fazenda de Posto, the new discovery, and then Butia, because we think we can actually increase that footprint. So we're trying to understand the geometry and just the size of the system at this point. But there's a lot of work to be done on that. Yeah.
Thank you.
You're welcome.
Round of applause, guys.